What's going on, everyone? Welcome back. Patrick here. Moving on to the next video. What I want to do is this example now. And as you could see, this example is pretty big. There's a lot written down. So first thing I want to mention is that I have this in my lecture notes already typed out for you. So you don't have to write out this example. So if you're on my site, lecture notes are at the beginning of the chapter. If you're watching this on YouTube, the lecture notes, there's a link in the description box. So let's see what's going on here. So we have a car manufacturer that has an assembly and a painting department. So actual data at the end of the period and estimated data at the beginning is below over here. So notice that split up into the assembly department, painting department. We got estimated overhead, actual overhead, estimated machine hours, actual machine hours, estimated direct labor hours, and then actual direct labor hours. And then with this information, what we have to do is we have to find the overhead variance in 3 different scenarios. So we have to find the variance if, number 1, the firm applies a plant-wide overhead rate based on either machine hours or direct labor hours. So that's like 2 different scenarios right there. And then the last scenario, the last question is we have to apply the firm applies overhead in the assembly department based on machine hours and in the painting department based on direct labor hours. So let's start off with 1A, where the plant-wide overhead rate is based on the machine hours. So what we're looking for is the overhead variance, and if you remember from videos before, when we are looking at the overhead variance, what we're looking at is how the applied overhead is related to the actual overhead, right? So if the applied overhead that we calculate is less than the actual overhead, then we under-applied overhead. Or if it's greater than the actual overhead, then we over-applied it. So notice that the actual overhead we already have, right, for both departments here. The $550,000 for the assembly department, the $415,000 for the painting department. So we don't necessarily have to worry about the actual overhead. It's the applied overhead that we're going to have to calculate. So how do we calculate applied overhead? Well, if you remember, there's steps, right? So the first thing we need to get is the predetermined overhead rate. And just in general, what is the predetermined overhead rate? Well, it's the estimated overhead over the estimated amount of cost driver. Right? Whatever that cost driver is that you are using. So if you remember, predetermined overhead rate, that is calculated at the beginning of the period. So that's another thing I want to mention. Notice that in this chart here, they give you a mix of estimated data, right? So you'll have this estimated here. Sometimes you'll see this shown as budgeted instead of estimated. And then you'll have the actual data. But what's tricky about these charts, especially if they put everything together, is that the estimated stuff, if you remember, it's happening at the beginning of the period, while the actual data that you get, right, it happens at the end of the period. The time has to go by for you to see what actually happened. So you got to be careful with these charts. They're not happening in the same time period a lot of times. Right? So it's not like you're looking at a balance sheet where on December 31st, the value of the assets on that date is this, the value of the liabilities is this, right? There's different sort of time frames. And sometimes they'll split up the estimated portion and they'll put in like one chart. Sometimes they'll split up the actual portion, put in another chart. But a lot of times they'll just mix it together, whether in a chart, whether in paragraphs, and you have to be able to differentiate it and know that it's happening in different time periods. So all these estimated rows, they're all happening at the beginning of the period. All the actual rows, all the actual data, we get at the end. So thought I would mention that as a differentiator. So let's calculate this predetermined overhead rate. So in 1A, we have to calculate a plant-wide overhead rate. Now, when you see plant-wide, what that means is for the entire firm or the entire plant, the entire factory. So what we have to do, this estimated overhead, we have to take it for the entire factory. So we got to take the estimated overhead at 600,000 plus the 400,000. Okay, so that's going to be the numerator. It's the overhead for the entire factory. It's not based on department. You got to total it up for the entire factory. In the third scenario, in question 2, right, that I had written out before, you're going to see that we're going to be working department specific. In this, since we're doing a plant-wide overhead rate, you got to look at the factory as a whole. Now, the denominator is estimated amount of a cost driver. So notice the cost driver in 1A is the machine hours, right? So you look at the estimated machine hours, not the actual machine hours. Remember, we're still at the beginning of the period when we are getting that overhead rate. So the estimated machine hours in total for the plant-wide, it's 8,000 plus 2,000. So this is 8,000 plus 2,000. Right? So what's going to happen is you're going to end up with 1 million in the numerator and then 10,000 in the denominator. And so when you divide those, what you'll get is $100 per hour or per machine hour. So we got our predetermined overhead rate, $100 per machine hour. And now that we have that, as that's at the beginning of the period, and then as the period goes on, we start applying overhead. And so what we want to know, let me draw this out again, is so as time goes by, right, the machines start getting used and we start applying overhead. And then we want to know how much overhead is applied by the end of the period, right? So we're going to have to look at the actual data to get that. So the applied overhead, just in general, it's the predetermined overhead rate that you calculated at the beginning times the actual amount of cost driver that you used up, that the overhead rate is based on. And by the end of the period, we've used 8,200 machine hours in the assembly department, 1,950 in the painting department. However, since, again, we're looking at this on a plant-wide basis, so the predetermined overhead rate is 100, we got to total these up over here, right, in this bracket, right, for the entire factory. So it would be 8,200 plus 1,950. Right, so you would do bed mass first, get this bracket. That would give you 10,150. When you multiply it by 100, you'd end up getting 1,015,000. So that there is the applied overhead for the entire period. So now that we have our applied overhead, we just have to compare it to the actual overhead, right? Because we're calculating the variance. The variance is the difference between the actual and the applied. And then the actual overhead is here. 550,000 for the assembly department, 415,000 for the painting. We're looking at it on a plant-wide basis, so we got to total those numbers up. And when you total them up, you would get 965,000. So that's the actual overhead that was incurred, but we applied 1,015,000. So what does that mean? Notice that we applied more than we were supposed to, right? So we over applied overhead. And it's just the difference between these two, which is 50,000. Right? So that there is your overhead variance. And so if you remember when I talked about underapplied versus overapplied overhead means that your costs on your statements right now, they are too high because you overapplied one of the costs. And so that means your cost of goods sold, the unadjusted cost of goods sold is too high. So you got to subtract this from the cost of goods sold to get the adjusted cost of goods sold. We're not doing that in this question, but thought I would mention it. Another thing I want to mention about what I just did is notice that we ran into 3 different kinds of overheads. I'm going to erase all this over here. Before we go further, we used estimated overhead. We had applied overhead. And then we had actual overhead. I don't know if you noticed that, but 3 types of overhead that we ran into. And that could be a cause of confusion for students sometimes. So remember, the estimated overhead, that's at the beginning of the period. And all we're using this for is to get our overhead rate. Nothing else. That's all we need the estimated overhead for, is to get the overhead rate, right? By dividing it by the estimated amount of the cost drivers. And then we use that overhead rate and the actual amount of the cost driver, we multiply them and we get our applied overhead rate, or not our applied overhead rate, our applied overhead in total. And actual overhead usually given in the question. And then what we're doing is just we are comparing these two to get the overhead variance. Right, so just from a high level, thought I would mention the difference between all 3. So let's move on to part B of number 1, where we apply a plant-wide overhead rate based on direct labor hours now. So before it was machine hours, now we're going to be working with the direct labor hours. Process is going to be exactly the same. So we got to get our overhead rate, or predetermined overhead rate. It's going to be the estimated amount of overhead, same thing, right? The 600,000 plus the 400,000. Oh, this is 400,000. And then we're going to divide it by the estimated amount of the cost driver, right? This is happening at the beginning of the period. And the cost driver in this case is the direct labor hours. So we're going to total these up since we're looking at it for plant-wide, which is 40,000. Right, so 15,000. I'll actually just split it up here. And these are total of 40,000. So 1,000,000 divided by 40,000, that gives us $25. And this is per direct labor hour. Right, so we're applying overhead now based on direct labor. So we got our overhead rate, and now we could calculate what our applied overhead is going to be. And the way we do that, we take our rate, 25, and multiply it by the actual amount of the cost driver that happened. And the actual amount of the direct labor hours, 13,500 for the assembly, 27,200 for the painting. And so we would just total these up here in a separate bracket. So 13,500 plus 27,200. And when you do that calculation, you end up getting 1,017,500. So that is the applied overhead, 1,017,500. And the actual overhead, same as the other question, that's already given, which is these two added up, so 965,000. And notice in this case, again, the overhead is over applied, right? The applied overhead is greater than the actual overhead. So we have over applied overhead and it's the difference between these, which is 52,500. Right, so both of them were over applied. So if this number that you got, the applied overhead, was less than 965,000, then it would be under applied, right? It would be the opposite. This would be under applied. That would be the variance, but both of them were over applied. And then the last scenario, number 2, we got to apply the overhead rates based on department, because in the assembly department, the cost driver is machine hours. In the painting department, the cost driver is direct labor hours. So I'm going to do these separately. So let's start off with the assembly first. So we'll have the overhead rate. And we're only going to look at the assembly column over here. So we take the estimated overhead, so the 600,000. So notice we aren't totaling it up for the firm or for the whole plant. We're just looking at the assembly portion right now. And divide it by the estimated amount of the cost driver. The cost driver is the machine hours. So the estimated machine hours, 8,000. And that's going to be $75. So $75 per machine hour. That's how overhead's going to be applied. Then we calculate the applied overhead. We would take the 75, the predetermined overhead rate, multiplied by the actual amount of the cost driver. The actual machine hours used is 8,200. And when you do that in your calculator, you end up getting 615,000. And then we have to compare that number to the actual overhead, which is 550. So the actual overhead is 550 for the assembly department. And so again, we over applied the overhead. Now remember, this is for the assembly department only. We over applied it by what? 65,000. Because the applied was greater than the actual. And then for the painting department, exact same process. So I wrote it all out over here. So get the overhead rate. We take the estimated overhead for the painting department, 400,000, divided by the estimated amount of the cost driver. Remember, for the painting department, cost driver is the direct labor hours. And the estimated direct labor hours, 25,000. So we get a predetermined overhead rate of 16. And then we apply the overhead by taking the rate, multiplying it by the actual amount of the cost driver, the actual direct labor hours in the painting department. When you do that, you get 435,200, right? So that's the applied overhead. What's the actual? Well, it's given as 415,000. And so again, what happened is we over applied the overhead. So to be honest, I could have made this example maybe a little bit better and kind of got a mix of under applied, over applied. Notice that it was over applied for all of the scenarios. To be honest, when I made this example, I just made sure that the predetermined overhead rates were going to be smooth when we did it in each department versus when we did it in a plant. But I could have got the overhead variances as well, right? So for all scenarios, it's over applied, but that's just because the applied is greater than the actual. That's not always going to happen. If the actual is less, or the applied is less than the actual, then it's going to be under applied, right? And sometimes they'll ask you after you do it by department. So remember, the assembly department had over applied overhead of 65,000. The painting department, 20,200. They'll ask you to total them up or net them out. So in this case, for the firm as a whole, or the plant as a whole, there was over applied overhead of both of these added together, 85,200. But sometimes, so that's for this specific question. But let's say, just as an example, let's say that we got under applied overhead of 40,000 here. Let's just pretend. Well, when you net these out now, notice that there's over-applied overhead of $65,000 and under-applied of $40,000. So when you net them out, there's still going to be $25,000 left of over-applied for the plant as a whole, right? Let's say this was, the under-applied overhead was $80,000. We got $80,000 over here. Well, notice there's more under-applied overhead that in this department than over-applied overhead in this department. So when you net them out, you'd end up having a difference of $15,000, and for the plant it would be under-applied because there's more under-applied. So as a firm then, or as a plant in total, there would be under-applied overhead of $15,000. So thought I would make a mention of that. But for this example, everything was over-applied. And yeah, that's basically how you do these questions. So sometimes be careful in the question. They'll be telling you that the overhead rate is based on plant-wide numbers. So you got to total all the departments up, right? Total up the estimated overhead, total up the cost drivers. Sometimes you're going to have to do it by department and then net everything out at the